and welcome viewers. I'm Hiral Dadia. We have Arun Sundaresan, Fund Manager and Head of Product at Nippon Life Asset Management, joining in. Arun, overall unprecedented times, not only for India, but across economies across the globe right now. And this is not only from the healthcare perspective, from the economic perspective as well. And to break it up, if you see what's happening with the markets around, what's the sense that you're picking up?
Sure. Thanks, Hiral. Thanks for joining the call today. And thanks to all joined us from Nirmal Bang team. Hiral, is it going to be a Q&A kind of a format, or you want me to cover the entire market perspectives now as a monologue? And then we
No, it'll be a Q&A format.
Okay. So, going to be a slightly lengthy answer. In fact, on the broad market perspective per se. So obviously, this COVID pandemic is very, very large, unprecedented. All of us do know that. In our estimate, each day of lockdown, and this is an estimate that we did during the earlier days of lockdown, where it was a complete lockdown. Our head of research and their team did an assessment where we estimated that each day of lockdown caused a loss of output of nearly 35,000 crores. So what we are talking about is for a 40-day lockdown, assuming that it goes on till May 3rd, we're talking about a loss of output of nearly 12-13 lakh crores, which is very huge, considering that India's GDP is $3 trillion, about 200 to 10 lakh crores. We're talking about nearly 6% of that getting wiped off. Obviously, after April 20th, with some relaxation, some bit of that could have got, kind of buttressed, and maybe going forward with pent-up demand, some bit of it could be recovered and so on and so forth. But fact of the matter is, in terms of the actual loss of output, it is very, very significant. So while this is at a broader economic level, it will equally apply in some cases a little more, some a little less to different parts of the economy. Some will have been more hit, like services related, and within that specific sectors like tourism, airline, etc. Whereas for certain other parts of the sectors, it could be a little less, but nonetheless, it is very large in terms of the size, in terms of the event, in terms of the unprecedented nature. That's where we stand today.
Right. So overall, if I have to ask you a question now, if you have to look at 2008, okay, we did see a lot of rallies that did come in an overall bear market. Similar is the kind of situation, Arun, we're seeing right now as well, because we've fallen from Jan highs, again seen a bounce back from March lows. And this is pretty much in tandem with what's happening across the globe. Do you think we are in a similar situation with how markets were in 2008, or would you place both of them very separately?
Okay, I'll give you two responses to that. Both are opposite and contradictory to each other. A lot of comparisons are being made, not only of 2008, of the last several market falls. I'm sure, you would have come across a lot of data pertaining to that markets had fallen by so much, and then it recovered, V-shaped recovered, 12 months, 13 months, this has been the kind of return and so on and so forth. I'm sure you would have come across those, 2008 it happened, 2001, this is how it was, 2013 it was like this, and, a lot of such comparisons. But I must tell you, and this is my first point, that we need to be a little wary about those kind of comparisons, because all of us do understand that while there can be some similarities in terms of fall and extent of fall and so on and so forth, the fact of the matter is today the issue that we are facing is very, very different. So every time it is different and unprecedented, but this time around, unlike even 2008 global financial crisis, it was largely a mortgage related subprime issue which originated in developed markets in US, spread to Europe, and then through a financial market spread to the rest of the world. Therefore, through a lot of liquidity measures, those kind of issues could be addressed and markets, quickly came back. Whereas today, what we are seeing is a very different issue altogether. Simultaneously, you have a demand destruction because of COVID-related issue. There has been huge supply disruptions as well, and more importantly, even as we remove lockdown and things slowly, gradually start coming up, you will still have a crisis of confidence. So even after the lockdown is lifted for some more time, or probably for a few more months, that can be a sense of kind of uh, you may not be operating at full capacity, and the normal ways of functioning may have been
mm,
disrupted. So therefore, this is a simultaneous kind of impact on demand, supply, and confidence, and therefore very, very different. And therefore, any comparisons with the past, only looking at market levels, could be very different. This is number one. The very different point is quite the opposite. People also say that, look, 2008, despite markets being limited only to financial markets, and it was largely subprime limited, but we saw a very large correction, something like 60%, and it lasted for 8 9 months. Whereas today, even for such a large event like this, we've not seen that kind of a correction, right? And therefore, should we be wary? There's another round of, there's another way of looking at things, saying that, are we not done yet? Is this too small a reaction? Is something that could, come quite opposite to what we just discussed now. But I must tell you, and this is something very important to notice here, 2008, when the global financial crisis happened, we were having the mother of bull run going into that crisis. So
mm.
from 2003 till 2008, we had markets going one way up year after year, and we had a substantial
Correct.
rally, correct? And consequently, when the global financial crisis happened, one of the valuation metric, market
Mm,
cap to GDP, was nearly 150%, 150. Today, uh, when we are faced with this COVID environment, we should keep in mind that for the last 4 5 years, overall economic growth has been slow. In fact, large parts of the economy, like corporate banks, telecom, pharma, a lot of these
mm,
cyclicals were going through structural slowdown. For
mm,
4 5 years, we've been struggling. Even from a market perspective, not only this sharp correction of 30%, you will have to see that in conjunction with what has been happening for the last 2 years. So 2018 and 2019, barring a handful of stocks, markets actually have been flat or negative. In fact, broader markets have been time correcting and value correcting for a while now. So this market correction will have to be seen in the overall context, and not just merely look at, March it's fallen only by 30%.
mm, mm,
Today, for example, the market cap to GDP number, and of course some pullback has happened, but the market cap to GDP number is now 55%, which during global financial crisis was 150%. So it is
mm,
in a way saying like this, like the equivalent of global financial crisis is now to say that Sensex was at 90,000 level, and then it corrected to 45 40,000. Whereas today it is like, from 42,000 you've corrected to 26 27, and you're back to 30 31 odd thousand levels.
mm,
So one needs to have these perspectives in mind. So despite uh, the large or the unprecedented nature of this issue,
mm.
the market correction also has been sharp, and I think it's fairly reflective of the actual problem.
Right. That's an interesting point that you're making. But from here on, as an investor, how much should an investor be prepared in terms of downfall? How much more pressure are we expected to see in terms of equity markets?
See, equity markets, even during normal times, it's difficult to time. All of us do know that. And to pick out a bottom at any point in time, and especially at these points in time, is going to be extremely difficult. Having said that, there are certain data points which are actually uh, pointing out that the worst possibly may be behind. Okay, and I'll tell you some numbers here. For instance, if you look at volatility index, VIX, so both in the US as well as in India, and during the peak of the times, and that was exactly 1 month back, which is when we had just started implementing the lockdown. There was a lot of uncertainty. The coronavirus had just spread to the US. There was a lot of fear. Therefore, the volatility across the world equity markets as well as in India was very high. In fact, the VIX index was 86 at that point in time.
Hmm.
Since then, that volatility has come down, and today that number is trading around 40, 42. So generally, what happens in finance is volatility tends to peak out before markets bottom out. So if this VIX was one kind of indication, similar kind of reaction was also seen in other markets, be it commodity markets or be it currency markets. For example, the one year forward
Hmm.
yields indicated in our currency was as high as 14%. So this was also way higher than what we even saw in the global financial crisis times.
Hmm.
Similarly, crude had also reacted very, very sharply.
Hmm.
All this is kind of indicative that, and since then they've recovered and come back to a level
Hmm.
where it is reasonable and kind of showing some kind of settling down. So by this measure, uh, uh, volatility having kind of peaked out, one can say that at least from that sense that the market, the bottom could have kind of got bottomed out. Not to say that, and that's true for any at any point in time, that one can't be sure, but at least broadly,
Hmm.
the extreme reactions seem to have already happened. See, all of us do need to remember one thing: capital markets, equity markets always tend to lead and lag. Today, unlike 1 month back when there was a lot of uncertainty, we don't know how lockdown, how long, and what format. US was just spreading. Today, the fact of the matter is it has spread to almost all parts of the world. Even in US, it has kind of spread. So many people have died, and now probably the curve is starting to flatten. Italy, for example, one of the worst impacted countries, even there from May 3rd or 4th, they're starting full operations. So going by anecdotal evidence as to what we are seeing in the different parts of the world, be it in China, Italy, Europe, and many other parts, the core issue of the coronavirus now seems to be a 2.5 months kind of a phenomena. From the time it starts to the way it peaks out and then eventually to flatten out, and the core issues tends to be for about 2.5 months. Possibly the economic impact could be slightly long drawn, given that slowly things will start coming back. And the net in China, Wuhan, for example, they've already starting to work. I mean, 80-85% is back to normal, and they have zero cases now, and so on and so forth. Even in India, the pace of uh, the infections, the rate has actually now it's getting doubled at 10.5 years, when during the peak it used to double in every 4 days. Sorry, 10.5 days, right? In Kerala, for example, it is 70-75 days now. So things are so with all these kind of understanding now, which was not the case some time back, the uncertainties possibly are behind, and therefore market reaction from that sense could be uh, lot more moderate from that sense.
Right. So, in this circumstance, Arun, what are the sectors, if someone really is sitting on cash, wants to invest from a long-term perspective, what sectors would you recommend and what would you say are avoid?
See, as I pointed out to you, the market correction has been sharp, absolute as well as in relative terms. Consequently, if you look at various valuation metric, and I pointed out market cap to GDP as one metric, other metrics as well. See, prior to this coronavirus, the Nifty, forget about FY21. So we are clearly writing it off. As I mentioned to you, uh, whether your GDP is going to be 0.5, 1%, 0, it's going to be conjuncture. We'll wait and see. But point is, this year is going to be a washout for GDP perspective as well as earnings perspective. Okay. Now coming to the next year, FY22, and my hypothesis here is that I mentioned to you is a 6 month kind of a broad phenomena. Slowly things start coming back. If not fully normal, gradually 75, 80%, and slowly will come back. Probably somewhere around the festival time. Maybe the last quarter of this fiscal, because of base effect and things improving, will start showing some improvement. And from there on, base effect and other things working will start, showing reasonably good results. But even writing off completely FY21, prior to the coronavirus, Nifty EPS was estimated to be around 765, 770
Hmm.
levels,
Hmm. Hmm.
the EPS level. Assuming that for the next 2 years, I'm not
Hmm.
talking about 6 months, all this pain taken, impact, and whatever it is, assuming that the earnings go down by 20% over the next 2 years from
Okay.
these levels,
Okay.
you're talking about 765, 770 EPS coming down to 620 or 630, around about those levels. So with that FY22 EPS, based on today's numbers, we're talking about 14 times 2-year forward P, right?
Hmm.
Which
Hmm.
again, is a attractive number both from a historic perspective as well as from an absolute perspective. For a 2-year forward PE to be around 14 times PE is a reasonably good number. So therefore, and I did mention to you market cap to GDP here. The long term, the 10-year average number there is 75%. Even in the last decade, when for the most periods we've had challenging times from an economic growth and market perspective, the average number there has been 75. Forget the 150% we had during the peak and the bull market types. So we are, kind of half that, not half, we are at 50, 55% of that number. So from a valuation perspective, uh, we are fairly attractive. Therefore, different parts of the market are quite attractive, whether you talk about large cap, mid cap, small cap. They do offer attractive opportunities. And I did mention to you, while some parts of the large caps did well, okay, the last 2 years as well, 2018 and 19, which gave you an impression that Sensex and Nifty did reasonably well. Mid caps and small caps, even during this time, they diverged. And, they've actually corrected for 2 years now. And this correction, which is again a 30-40% correction, you're talking about a complete 3-year, 3.5 year kind of loss. And if you look at last 5 years, except 2017, 2015 was flat, 2016 was flat, 18, 19, and now 2020. So we're talking about a very long period of time when markets have not gone anywhere. So from that perspective, they're very attractive. As far as sector is concerned, different sectors are again looking very attractive. In fact, except even now, the consumer sector, FMCG sector, which valuation wise was very, very expensive, even that has taken a correction. And
Hmm.
in
Hmm.
some pockets, you have, reasonable valuations now. Having mentioned that, except that, rest of the markets, whether it is banks, both corporate banks as well as retail banks, they've also had a significant correction, right? Why? Because obviously their own market cap was very, very high. They were very favored from a market perspective and that correction has been sharp there because some bit of financial leverage is there in banks. So they've also corrected a bit. So I think from a valuation perspective, given the correction, they are also attractive. And many other parts of the markets, like pharma, for example, is looking quite attractive as well. So utilities, a lot of these companies which are leaders, it could be the ITCs, it could be Hindustan Zincs and those kind of companies, which are large and respective leaders in their segments. Uh, you know, their dividend yields today are more than FD yields. That kind of valuation is what they are, kind of trading. They may not be growth companies per se, but the valuations are so attractive that their dividend yields are more than, FD yields. So you have pockets of opportunities across these high dividend yielding companies. You also have the high growth companies here. I mean, the
Hmm.
private
Hmm.
banks and even some kind of FMCG and those kind of companies which have become reasonably attractive after the correction. And the last bit,
Correct.
the cyclicals. When I'm saying cyclicals, automobile, auto ancillary kind of companies, even corporate banks. So there one has to be selective, better to avoid financial leverage company like NBFC and those kind of extreme. those for the time being, you'll be better off avoiding it unless you want to take a very tactical and very contra call there. But within that, those kind of companies, for example, automobile companies, they are nearly zero debt. However, they offer a lot of operating leverage. And given that they had taken a very, very sharp
Hmm,
correction and
hmm,
over,
hmm.
so you have quite a bit of opportunity across the spectrum, whether it is on market cap or on sectors.
Right. So I get your point in terms of the sectors where there are opportunities. Now, another point I want to discuss with you, Arun, is with regards to today's RBI circular, which did come up. I mean, RBI came up with a 50,000 crore liquidity facility for mutual funds. How much do you feel it could actually help debt funds?
Okay, so see, debt markets overall, the environment actually has been conducive, especially from March 27th onwards when RBI made those announcements, exactly a month. Just like equity markets, and I mentioned other parts of the market, the debt markets also had become extremely volatile going into that week. In fact, yields across the curve, whether it was AAA, whether it was high grade, everything has gone up like 100, 150, basis point. So uh, RBI thankfully came to the rescue very, very swiftly on March 27th. They made a slew of announcements. They cut the rate, both repo and the reverse repo rate. CRR was cut. The MSF was increased. Targeted LTRO announcement was made. All of these things were infusing a liquidity of 3.7 lakh crores. So the debt markets recovered all of the losses instantaneously. In fact, immediately afterward, levels were back to how things were before the corona virus, started impacting the debt markets. That was the kind of reaction. They followed that up with further reverse repo cut in order to discourage the banks from keeping excess and then to onward lend. And they came out with this LTRO 2.0, where they said apart from corporate bonds, the previous one was high grade corporate bond. This time, very targeted towards NBFCs and MFIs. So that should also be done. So all of these things, both from a quantum as well as from a directional perspective, helps market. Now the latest episode is all of us are aware about the Templeton closing down, and therefore some bit of concerns and worry that redemptions could hit and so on and so forth. So again, they've acted very swiftly and announced this 50,000 crore special liquidity window for mutual funds to meet such redemption. So basically, what it means is that mutual funds can use this window to borrow in case they face excess redemption. So this again is, in my view, more directional. Let me tell you, way back in 2008, when similar issue was faced by the industry, RBI came out with a liquidity window of 20,000 crore,
Correct.
but only 3,500 crores out of that was utilized by the industry, right? So this is more directional. It is not that if you have 50,000 crores, you will face 50,000 crore redemption and the entire thing will be used. But the very fact that there is some line available, that even if a little bit of more redemptions happen, that can be comfortably met. So that's where we stand today. I think it's a good development. In fact, today the markets have been flat, no reaction at all. Like you've not seen yields moving up and so on and so forth. So I think this issue is, if not already settled, will get settled, very, very soon.
Right. And, fund managers are actually assuring investors also to stay patient during this time. Uh, Especially, if you talk about the mutual fund houses as well, a bulk of which are NBFCs, also are facing some majority liquidity stress. And this is on the back of the delinquencies. What's your take?
So see, I would absolutely subscribe to the views that are broadly coming in.
Hmm.
And this is applicable both for equity as well as debt. So whenever there is excess panic in the market, one part of the market, there will be extreme reaction. So which will reflect in the prices, whether sharp deterioration in case of equity prices going
Hmm.
down, or in the case of debt, that part yields going up, which means that prices are already reacting, probably overreacting to all of these moves. So the best thing to do in such things is not have any knee jerk reaction. And investors, as long as they are clear about their asset allocation, and in this case, for example, if credit funds are a small part of their overall holding, and anyway they've invested for the longer term, there is absolutely no need to kind of react negatively, redeem
Hmm.
for the sake of it, and so on and so forth. Having said that, overall, for a while now, not just because of Templeton, for the last 1 year or so, 1.5 years or so, ever since the ILNFS issue happened, that part of the market has been a little bit of under pressure, so to say. The credit funds itself had come down from 1.25 lakh crores to 50,000 crores. So the industry has been handling this fairly well. They've been orderly meeting those redemptions and so on and so forth. They will continue to do that. Now with this extra support, I think it can easily scale through. Now, all of these players, see, one needs to understand this important fact that mutual funds, even in the credit space, generally tends to operate in a reasonably high grade. The other day, ICRA has come out and given a list of issuers which have opted for moratorium. There were almost 328 such issuers. All of them are, in fact, I looked at that list and looked at, the holdings that we have. I could figure out only two names which have asked for
Hmm.
moratorium. So generally, the point I'm making here is that mutual fund tends to invest into a completely different space altogether. So these tends to be fairly, even within the credit space, fairly good quality names, reasonable, even in normal bad times, moderate liquidity, uh, structured assets was self-liquidating in nature, and those kind of assets. So reasonably well placed from that perspective, which is why the entire industry has been able to manage the show. All this while, we've been running funds for the last 15 years now. Our own funds, we face significant redemptions. Credit risk fund, for example, has come down from 11,000 crores to 2,700 crores now. And all this period, we've been managing this very, very well, right? In terms of meeting the liquidity and,
Hmm.
that
Hmm.
part of the obligation. I don't see any challenge on that part, at least going forward as well. So no need to panic from that sense. Uh, Having said that, honestly, if you look at it from an absolute yield perspective, very attractive.
Hmm.
And I believe that some non-traditional players in this part of the market, including banks, IDFs, etc., have now started to show interest
Hmm.
to pick up, some of these papers at these levels. Because see, smart investors do understand that one, these yields are attractive and they are
Attractive.
available
Correct.
to you.
Correct.
Yeah, given the challenges and whatever, that's one. And you
Hmm.
also know that some risk appetite is going to come back, and either through RBI support, and it's already come through, right? So given all of these things, that space is actually well placed. But on that, we'll have to respect investors' mandate, and if they are kind of, for some reason, if they want to move out and if they want to, kind of take decisions, it can be on.
Right. But we're talking about the biggest episode right now is with regards to Franklin Templeton. What's happened on that front? Do you think this would probably be a start to some form of a trend that the mutual fund industry will adopt? Because retail investors or something are now worried about this.
Yeah, Hiral, see, what has happened with Templeton again is a very specific issue. I would again use this word unprecedented. See,
Hmm.
their issue was completely different. And many of you would be aware, it's not fair on me to comment, but then since it's a small group, see, they used to run credit across funds, number one, and significantly loaded in that sense. Like most of the funds, will have 60, 70%, if not more, in such, credits, which is normally not how many AMCs, including us, traditionally had been running credit funds. So if you look at our funds, typically you will have 90 or 100 different securities,
Hmm.
and the portfolio will be built in such a manner that it will be well spread across different maturities, different types of asset. Many of them will be self-liquidating in nature. It could
Hmm.
be PTCs. It could be that at any point in time you will have you know uh, something or the other maturing in the next 1 month or 2 months. So all of these things are uh, able to kind of keep you in good stead in terms of meeting your liability profile. So that's how things are. You will have typically 20, 25, 30% into AAA, AA plus. Some bit will be into good quality AA, and it's very well spread, which was not the case with Templeton. So to that extent, plus their size also was very big. So all these funds put together, 6 funds put together, past 10 it was nearly about 30,000 crore, which out of their fixed income AUM was maybe 50, 60%, or overall AUM was 30, 40% of their overall AUM, which is not the case with any other fund house. Probably, that part of the, see, for us, all these funds put together account for 7% of our portfolio, not only credit risk, even where we have taken exposure in some of the other funds. If you combine everything, look at the exposures, this is hardly 7% of our overall portfolio. So to that extent, I would tend to believe that the Templeton issue is very different. And again, one more point is that Templeton, unlike us, we've been facing redemption for the last 1.5 years now. They have not had redemptions as well. So kind of their AUMs were still very large, right? Probably things started going bad once Vodafone thing happened in the last 2-3 months, and suddenly it was a perfect storm. The asset size was very large at one point in time, and then you have concentrated or rather large exposures
Correct.
to so-called credit, and then simultaneously large redemptions hitting them, and then it was kind of getting to a liquidity issue which was becoming unmanageable except for this. So I don't think we need to extrapolate that and assume that the entire industry will be kind of plagued with this. I think things should be a lot better as we go ahead. Yeah.
Right. But always it was always perceived that debt mutual funds have been way safer a bet versus equity, funds. Do you think that tide will turn now? Because a lot of investors come and ask, questions like, okay, is it safer to invest in equity mutual funds versus debt?
Yeah, so in this environment, that has come under question, saying, and in this case, one more thing we need to keep in mind is that even with Templeton, it's not that they're saying it will lead to a loss of your investment, and in fact, they're claiming on the contrary that this is in the best interest of investor, and gradually it can be sold without value destroying and returns. Of course, one is you're not going to get your money back immediately, but ultimately you're going to realize the best value, including your interest and what could accrue over a period of next 1 year or whatever it is. So even now, it is
Correct.
not a question of losing returns. Obviously, this part about liquidity, when I want redemption, I can't get right. That has taken a big hit. Yes, so that will call for a lot of risk. But again, I wouldn't like to come to a conclusion basis this that obviously debt is more risky than equity. It is not the case at all, whether it is theoretical or practical. Even today, even if you look at some of the funds where there have been some credit issues and so on and so forth, yes, returns do look on the lower side, sometimes negative side, etc. But then with time that thing will get kind of materially addressed, and there is no way you can compare that with as well. So uh, and generally, uh, 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 you know, during these difficult times, extreme times, taking inferences or taking investment decisions at that point in time actually also would be extreme. It is again like saying that today, for example, equity 5-year returns is negative or 1%, 2%. So does that mean that equity itself, even for long term, doesn't make sense? The answer is no, because you are looking at returns at a point in time when, for various reasons, it is at a low point, and therefore it looks very, very muted. But give it some time, maybe it will rise another 20, 30%, and it can happen in quick time. All of us do know that from a 30,000 level, a 2030 is another 6,000, 7,000 points. It can happen in quick time, right? And suddenly your 2% return will look like it's 7% or 8%, and then things will start improving. So investors should refrain, and that's where Nirmal Bang, you guys should also, kind of keep iterating to them that, uh, one should not take extreme view or extreme, investment decisions when things are down and out, that kind of stuff.
Right. That's an interesting perspective, Arun, that we're picking up from you as well. In fact, because right now as well, if you see in terms of the SIP data, yes, we've seen a decline, and that is something which will remain. But there is a possibility as well where once the investor trust comes in back to the markets, we could see a lot better. And I think someone who is a long-term investor, this could be the best opportunity and the best valuations that you could pick in sectors which are not really available. Cheap are always on an expensive mode. But thank you, Arun, for joining us on the show with your great insights as well as your views that you hold for the markets as well. That's all that we have, ladies and gentlemen, on the show. Thank you for watching.